While you sleep, an entity you never voted for is deciding the price of your home, the stability of your pension, and the future of the global economy. It's not the government. It's not the Federal Reserve. It is an algorithm. Its name is Aladdin. A cold, probabilistic system that evaluates risk faster than any human institution in history. It manages more than $21 trillion in assets, more than the combined GDP of China and Japan. You don't know its name. You didn't consent to its authority, but it knows your mortgage, your retirement fund, and the companies you depend on to survive. Today, we open a sealed vault. This is the hidden file on the firm that quietly became the fourth branch of power. This is BlackRock. To understand BlackRock, you must abandon the traditional definition of a corporation. BlackRock is not a bank. It does not take deposits. It does not issue credit cards. It does not look like power, and that is by design. BlackRock is an asset manager. That distinction is not cosmetic. It is structural. Banks use their own balance sheets. Asset managers control other people's money. Pension funds, sovereign wealth funds, insurance reserves, endowments, and retirement accounts without legally owning it. Control without ownership is the most efficient form of power ever created in modern finance. BlackRock was founded in 1988 by Larry Fink, a former bond trader at First Boston. His career nearly ended after a single miscalculation in interest rate risk cost his firm more than $100 million. That failure became the blueprint. Fink concluded that the global financial system was not limited by capital, but by the inability to measure and price risk accurately. The markets were blind, so he built a firm around seeing what others could not. BlackRock began as a risk management consultancy focused on fixed income securities. It did not compete with banks. It advised them. It modeled interest rate exposure, credit defaults, and derivative chains that most institutions barely understood. By the late 1990s, BlackRock was no longer standing outside portfolios. It was embedded inside them. The real expansion came after the 2008 financial crisis. While banks collapsed under toxic mortgage assets, BlackRock grew. Governments needed someone to value what could no longer be priced. BlackRock was hired to analyze, manage, and unwind failed institutions and emergency portfolios. Trust migrated. Authority followed. Today, BlackRock manages over $10 trillion in assets under management. That figure alone would make it the most powerful financial entity on Earth, but it understates the real reach. Through passive index funds, especially iShares ETFs, BlackRock became the largest or second largest shareholder in the majority of S&P 500 companies. Apple, Microsoft, Amazon, Exxon, Pfizer, Nestle. These corporations compete publicly. Their largest shareholder does not. BlackRock does not select individual winners. It owns the system that defines the field of competition. If you contribute to a pension plan, there is a statistical likelihood your savings are routed through a BlackRock-managed structure. If a government invests reserves, BlackRock is often the intermediary. If a corporation issues bonds, BlackRock is on the other side of the transaction. The firm sits at the central junction of global capital flows. No election, no popular mandate, no oversight committee with proportional authority. This is not market dominance. This is market infrastructure. Money alone does not create control. Information does.
In the late 1980s, Larry Fink understood something most institutions ignored. Financial systems do not fail because of insufficient capital. They fail because of unmanaged correlation. When decisions are decentralized, risk is distributed. When everyone relies on the same assumptions, risk concentrates. To solve this, BlackRock built Aladdin, asset, liability, debt, and derivative investment network, not a tool, a nervous system. Aladdin ingests decades of historical price data, macroeconomic indicators, yield curves, credit spreads, derivatives exposure, liquidity constraints, and geopolitical variables. It stress tests portfolios against hypothetical shocks, interest rate spikes, commodity collapses, currency crises, pandemics, wars. It assigns probabilities to outcomes humans cannot calculate at scale or speed. Aladdin does not only manage BlackRock's internal portfolios, it provides risk analytics and decision frameworks to more than 200 of the world's largest financial institutions, pension funds, insurance conglomerates, sovereign wealth funds, central banks, the U.S. Treasury, the European Central Bank, the Bank of Japan. In total, Aladdin influences risk decisions for more than $21 trillion in assets. This creates a financial monoculture. When Aladdin signals rising risk, institutions de-risk together. Assets are sold simultaneously. Liquidity evaporates. Volatility spikes. What appears to be market panic is often synchronized execution, a single analytical framework guiding trillions of dollars at the same time. In 2020, during the COVID market collapse, the Federal Reserve outsourced parts of its emergency bond buying programs to BlackRock. The firm was tasked with executing monetary policy in real time using its own infrastructure. Aladdin became the operating system of crisis response. This is not speculation, it is documented policy. The structural consequence is unavoidable. Markets no longer react organically, they respond to signals generated by the same machine. Diversity of strategy disappears, stability becomes conditional, fragility increases. When one system models the world, its blind spots become systemic. After decades of capital accumulation in stocks, bonds, and derivatives, the focus shifted. After 2020, capital moved into land. Between 2020 and 2024, institutional investors executed what analysts now call the Great Real Estate Transfer. Low interest rates, emergency liquidity, and algorithmic forecasting converged. Residential housing was reclassified, not as shelter, as yield. BlackRock and its peers identified single-family homes as underpriced relative to inflation protection and long-term rental demand. Using pooled capital and low-cost financing, institutional buyers outbid families, often with cash offers, waived inspections, and accelerated closings. In many U.S. metropolitan areas, corporate buyers accounted for more than 20% of home purchases. In some neighborhoods, the figure exceeded 40%. This was not speculation, this was allocation. Homes were converted into rental units. Rent was algorithmically adjusted. Maintenance was outsourced. Evictions were automated. What was once ownership became subscription. BlackRock has publicly stated it does not directly purchase individual homes at scale. That statement is technically accurate. The exposure is indirect. Through funds, real estate partnerships, REITs, and advisory structures, control without visible fingerprints. The result is mathematical. Supply is constrained, demand is institutional, prices rise, ownership declines. A generation is priced out not by wages, but by capital efficiency. This is not a housing shortage. This is a balance sheet reconfiguration. The phrase, "you will own nothing," was not ideological. It was predictive. The final layer is governance. BlackRock executives do not campaign for office. They circulate through power. The revolving door between BlackRock and the U.S. government is not hidden. It is normalized. Brian Dees, former global head of sustainable investing at BlackRock, became director of the National Economic Council. Adewale Adeyemo, former BlackRock executive, became deputy secretary of the Treasury. Michael Pyle, former BlackRock strategist, joined the White House as chief economic advisor to the vice president. When crises erupt, BlackRock is not consulted as a lobbyist. It is deployed as an operator. Then there is ESG. Environmental, social, and governance scoring is presented as neutral risk management. In practice, it